Ladies and gentlemen, this is not a drill. We are entering the final countdown. It is Friday evening, January 3rd, 2026, 6:28 post-meridian Moscow, Standard Time. And as I speak to you right now, across the Atlantic Ocean, the United States commercial real estate market is experiencing what can only be described as a controlled demolition. Except nobody is controlling it anymore. My name is Michael Sterling, known to many of you as the Real Estate Reaper, and I have spent the last 72 hours buried in data that will make your blood run cold. I have been tracking loan maturity schedules. I have been analyzing Federal Reserve emergency lending facilities. I have been speaking with sources inside regional banks who are, quite frankly, terrified to go to work on Monday morning. Here is what you need to understand immediately. There is no longer a single price for office real estate in America. The market has fractured. It has bifurcated. It has split into two completely separate realities, and most investors are staring at the wrong one. On your screen right now, if you pull up commercial real estate indexes, you will see average office building valuations listed at 174 United States dollars per square foot. That number is a lie. That number is a ghost. That number represents nothing more than the wishful thinking of lenders who cannot afford to mark their loan books to reality. Because while that number flashes on Bloomberg terminals and real estate databases, the actual price, the price at which buildings are actually changing hands when forced sales occur, is somewhere between $80 and $90 per square foot in secondary markets. In some tertiary markets, we are seeing transactions at $60 per square foot. That is not a correction, ladies and gentlemen. That is not a bear market. That is a 65% wipeout. Let me say that again, because I need you to understand the magnitude of what is happening. 65%. Office buildings that were valued at 10 million United States dollars 18 months ago are selling for 3.5 million today. And those are the lucky ones that can find buyers at all. The bifurcation is complete. There is the paper price, the price on the loan documents sitting in bank vaults. And there is the real price, the price that desperate sellers will accept when the debt maturity date arrives and the bank says no extension. These two prices now exist in completely different universes. And over the next 36 hours, we're going to watch those universes collide. So buckle up, turn off your distractions, because I'm going to walk you through three distinct levels of this market that have emerged. I am going to show you the mathematical impossibility of the current situation. And I'm going to explain exactly why Monday morning, January 6th, 2026 will be remembered as the day the commercial real estate market admitted what everyone already knew. The office building as an asset class is dying, and it is taking regional banks down with it. Let us begin by dissecting the three-tiered reality that has emerged in office real estate, because understanding these three levels is essential to grasping why this market is about to experience a violent repricing that will echo through the financial system for years. At the top of our pyramid sits what I call the panic price. These are the transactions happening right now in distress situations where borrowers face imminent loan maturity, where lenders have finally lost patience, and where reality can no longer be postponed. In San Francisco, we are seeing office buildings trade at 2,733 United States dollars per square meter. Now, let me convert that for you, because the numbers need to be understood. That works out to approximately $254 per square foot. You might think, well, that does not sound so bad. But here is the critical context. In 2021, those exact same buildings were trading at over $5,000 per square meter. Let me do the mathematics for you, step by step, because this is where it gets horrifying. If a building sold for $5,000 per square meter in 2021, and it is selling for $2,733 per square meter today, what is the percentage decline? Take 5,000 minus 2,733. That equals 2,267. Now divide 2,267 by 5,000. Multiply by 100. The answer is 45.34%. That building lost 45% of its value in less than 4 years. But wait, it gets worse. Because that $2,733 per square meter price, that is only happening in San Francisco, which is still one of the premium markets. In Austin, Texas, where vacancy rates have exploded to 28.9%, the numbers are far more savage. In secondary markets across the Sun Belt, we are seeing Class B office buildings trade at $1,500 per square meter. That is a 70% decline from peak. 70%. Three-quarters of the value. Evaporated. These are not hypothetical numbers. These are closed transactions. These are buildings that sold. These are prices that desperate sellers accepted because the alternative was foreclosure, bankruptcy, or both. Now let us move to level 2, what I call the fantasy price. This is the price that most office buildings are still being carried at on bank balance sheets. This is the number that appraisers are still putting in their reports when they use comparable sales from 2021. This is the number that lenders need to believe in, because if they admit the truth, their capital ratios collapse. According to official indexes, the average office building in America is valued at 174 United States dollars per square foot. This represents an 11% decline from 2023. 11%. The official narrative wants you to believe that office real estate has experienced a mild correction, a bump in the road, a temporary adjustment. But remember level 1. Remember those 45% to 70% declines in actual transactions. How can both numbers be true? They cannot. This is the heart of the bifurcation. The fantasy price exists on paper. The panic price exists in reality. And the gap between them represents trillions of dollars in unrealized losses sitting on bank balance sheets. Let me show you the mathematical impossibility. According to Federal Reserve data, regional banks in America hold approximately 2.8 trillion United States dollars in commercial real estate loans, 44% of their total loan books. Let us assume, conservatively, that 30% of those loans are office buildings. That gives us $840 billion in office exposure across regional banks. Now, if office buildings are really worth 40 to 60% less than the loan values on those books, and the transaction data proves they are, then regional banks are sitting on unrealized losses of somewhere between $336 billion and $504 billion United States dollars. $336 billion to $504 billion. Let me write that out. $336,000 million to $504,000 million. That is more than the entire gross domestic product of many developed nations. That is enough to wipe out the equity capital of the entire regional banking sector multiple times over. But here is the beautiful trick the banks are using. They do not have to recognize those losses until the loan matures. As long as the borrower keeps making interest payments, as long as the loan does not default, the bank can keep pretending the collateral is worth the loan amount. They can keep carrying it at the fantasy price. This works beautifully in normal times. But ladies and gentlemen, we are not in normal times. Which brings us to level 3, the zombie price. These are the buildings that are not selling at all. These are the properties trapped in a netherworld between hope and despair. According to the latest data from Moody's Analytics, the national office vacancy rate has surged to 20.7%. Let me say that again, 20.7%. More than 1 in every 5 office spaces in America is sitting empty, generating 0 rent, producing 0 cash flow. In certain markets, it is far worse. San Francisco, 29% vacant. Austin, 28.9% vacant. These are not offices that are between tenants. These are structural vacancies. These are floors that have been dark for years. These are lobbies where the elevators no longer run because there's nobody to ride them. Now, what happens when you own an office building that is 29% vacant? Let me walk you through the financial death spiral, step by painful step. Step 1. Your rental income drops by 29% immediately. If you were collecting 1 million United States dollars per year in rent, you are now collecting 710,000. Step 2. Your expenses do not drop by 29%. You still pay property taxes on the full building. You still heat and cool the common areas. You still maintain the elevators. your expenses might drop 10% at most. So if you were spending $400,000 per year on expenses, you are now spending $360,000. Step 3. Your net operating income collapses. You went from $600,000 per year in net income to $350,000. That is a 41.7% decline in cash flow. Step 4. Your debt service does not decline at all. If you borrowed $10 million at 6% interest, you owe $600,000 per year in interest. But now you only have $350,000 in net operating income. Step 5. You are insolvent. You are losing $250,000 per year. You are burning through cash. You are draining reserves. And there is no way out. This is the zombie price reality. These buildings cannot be sold because nobody wants them. They cannot be refinanced because the cash flow does not support the debt. They cannot be demolished because the demolition cost exceeds the land value. They're the walking dead. And there are hundreds of billions of dollars of these zombie price properties sitting in portfolios across America right now, with loan maturity dates approaching like a freight train. Now that you understand the three-tiered price structure, let me explain why the next 36 hours represent a point of no return. Let me introduce you to what insiders call the maturity wall. And trust me when I tell you, this wall is about to collapse on top of the entire commercial real estate sector. Here are the numbers, and I need you to pay close attention because these numbers are going to dominate financial headlines for the next 2 years. According to S&P Global Market Intelligence, there is approximately $950 billion United States dollars in commercial real estate debt maturing in 2024 and 2025 combined. Of that, roughly 30% is office buildings. That gives us $285 billion in office loans coming due. But wait, it gets worse. According to Fortress Investment Group, when we expand the time frame to include 2026 through 2029, the total commercial real estate debt maturity figure explodes to over $4 trillion United States dollars. 4 trillion. 4,000 billion. And office buildings represent somewhere between 1 trillion and 1.2 trillion of that total. Let me put that in perspective. $1 trillion in office building debt. If the buildings securing those loans have declined 40 to 60% in value, then the collateral shortfall, the difference between what is owed and what the buildings are worth, is somewhere between 400 billion and 600 billion United States dollars. That is 400,000 million to 600,000 million dollars in losses that have to be recognized, absorbed, written off, and somebody has to eat those losses. The question is, who? Let me tell you why Monday morning, January 6th, is so critical. Over the weekend, I received information from a source at a mid-sized regional bank in the Midwest. I cannot name the bank for obvious reasons, but I can tell you they have $17 billion in total assets and about $7 billion in commercial real estate loans. That is 41% CRE concentration, right in line with the industry average for regional banks. According to my source, this bank has 12 office building loans totaling 160 million United States dollars maturing between January and March of 2026. 12 loans, 160 million. All of them require refinancing or repayment. Here is the problem. The bank conducted fresh appraisals on 10 of those 12 properties over the past 60 days. Do you know what they found? The average decline in appraised value was 38%. 38%. Properties that were valued at $20 million when the loans were made are now appraising at $12.4 million. Let me do the mathematics. 12 loans totaling $160 million. If the average loan-to-value at origination was 70%, that means the properties were originally valued at approximately $229 million. But if values have declined by 38%, those same properties are now worth $142 million. The borrowers owe $160 million. The collateral is worth $142 million. There is an $18 million shortfall, and the bank has 3 choices, none of them good. Choice A, extend the loans and pretend everything is fine. But the regulators are watching. And if the bank extends performing loans on underwater collateral without proper reserves, the examiners will hammer them on the next audit. Choice B. Demand that the borrowers pay down the loans to match the new appraised values. Where are commercial real estate borrowers going to find $18 million in cash in this environment? They cannot. So this option leads directly to default. Choice C. Foreclose, take the properties back and sell them. But selling means crystallizing the loss. It means writing off $18 million. And when you're a bank with only $1 billion in equity capital, an $18 million loss is serious. Multiply that across every office loan on the books, and the losses become catastrophic. Now expand that single bank's dilemma across the entire regional banking sector. Remember, regional banks hold 44% of all their loans in commercial real estate. Large banks only hold 13%. What this means is that regional banks are grotesquely overexposed to a collapsing asset class. And here is the truly terrifying part. When one regional bank starts foreclosing and selling office buildings at panic prices, it sets the comparable sales that every other bank must use for appraisals. Imagine, Bank A forecloses on an office building in Dallas. They are desperate. They need to clear the asset off their books. They accept a bid that values the property at $55 per square foot, a 60% decline from the loan origination value. That sale is now public record. Now Bank B, which has 5 office loans in Dallas, has to explain to regulators why their properties are still being carried at $130 per square foot when comparable properties are selling at $55. The answer is they cannot explain it. So Bank B is forced to write down their loans. When they write down their loans, their capital ratios decline. When their capital ratios decline, regulators start asking uncomfortable questions. When regulators start asking questions, depositors start getting nervous. When depositors get nervous, they withdraw funds. When funds are withdrawn, the bank has a liquidity crisis. This is not theoretical. This is exactly what happened in March of 2023 with Silicon Valley Bank and First Republic. Except now, the trigger is not duration risk on bond portfolios. The trigger is collateral collapse on commercial real estate loans. And the exposure is far, far larger. Let me paint you a picture of what refinancing looks like in today's market, because this is where the maturity wall becomes unsurmountable. Imagine you're a commercial real estate borrower. You own an office building in Chicago. 10 years ago, you bought it for $20 million United States dollars. You took out a loan for $14 million at 4% interest. The loan matures in February 2026. That is next month. 10 years ago, your building was 80% occupied. Today, it is 55% occupied. Your net operating income has collapsed from $1.6 million per year to $800,000. You call your banker. You ask for a loan extension. The banker orders a new appraisal. The building now appraises at $11 million, a 45% decline. The banker says, "We will extend your loan, but at the new appraised value. We will lend you 70% of $11 million. That is $7.7 million. You owe $14 million. The new loan is $7.7 million. You need to bring $6.3 million in cash to closing to refinance your own building. Do you have $6.3 million in cash? Of course not. If you had $6.3 million in cash, you would not be borrowing money in the first place. So what happens? You default. The bank forecloses. The building gets dumped on the market at panic price. The bank absorbs the $6.3 million loss. The building sells for $8 million if they are lucky, and the death spiral accelerates. Now multiply that scenario by thousands of borrowers across thousands of office buildings, and you understand why we are looking at the greatest wave of commercial real estate defaults in modern history beginning right now. Right this month, January 2026, is when the maturity wall starts to crumble, and by December, it will be rubble. While everyone was celebrating the holidays, something very interesting was happening at the Federal Reserve, something that barely made headlines. Something that should terrify anyone who understands what it means. Let me take you back to March of 2023. Silicon Valley Bank collapsed. First Republic followed. The banking system teetered. and the Federal Reserve activated an emergency lending facility called the Bank Term Funding Program. This facility allowed banks to borrow money from the Fed using securities as collateral, and critically, those securities were valued at par, not at market. That program officially ended in March of 2024. Officially. But what the mainstream media has not told you is that other Fed lending facilities have quietly exploded in usage over the past 6 months. According to Federal Reserve H.4.1 data, and yes, I read the actual Fed reports, not the summaries, borrowing from the Fed discount window by small banks has increased by 43% between June and December of 2025. 43%. Small banks are flooding back to the Fed begging for cash. Why? Because their commercial real estate loans are bleeding them dry. Because depositors are slowly withdrawing funds. Because they are trapped between insolvent borrowers and nervous regulators. And because they have nowhere else to turn. Let me give you specific numbers. In June of 2025, total discount window borrowing was approximately 11 billion United States dollars. By December, it had risen to 15.7 billion. That is an increase of $4.7 billion in 6 months. Now, I know what you are thinking. $4.7 billion does not sound like that much in the context of a multi-trillion-dollar banking system. And you are right. It is not a crisis yet, but it is a warning siren. It is smoke coming from the engine room, and the direction is unmistakable, up. Let me tell you about a bank we are watching very closely. I'm not going to name them specifically because they are publicly traded and I do not want to be accused of market manipulation. But I can tell you this. They are a regional bank with approximately $50 billion in total assets. They operate in the Southwest, and they have publicly disclosed that commercial real estate represents 47% of their loan portfolio. According to their most recent quarterly filing, they increased their loan loss reserves by 600 million United States dollars in the third quarter of 2025. 600 million. That is not a normal quarterly reserve build. That is panic. Why did they increase reserves by 600 million? Because they know what is coming. They have run the numbers on their office portfolio. They have seen the appraisals. They have watched vacancy rates in their markets climb past 25%. And they have done the mathematics on what happens when $40 billion of commercial real estate loans start to default. Let me walk you through that mathematics because this is critical. If they have $50 billion in total assets and 47% is commercial real estate, that means $23.5 billion in CRE loans. If 30% of that is office buildings, we are looking at $7 billion in office exposure. Now, if those office buildings have declined 40% in value on average, conservative based on the transaction data we have reviewed, then the collateral shortfall is $2.8 billion. They just increased reserves by 600 million. They are still 2.2 billion short of covering the potential losses. What happens when investors figure this out? What happens when depositors figure this out? The stock price collapses, deposits flee, and the Fed has to step in. Again. But here's what really makes me angry. Here is the part that should make your blood boil. While office building owners are getting foreclosed on, while small businesses are losing everything, while regional banks are teetering on insolvency, the Federal Reserve is quietly subsidizing the entire charade through emergency lending. Banks borrow from the Fed at the discount rate, currently around 4.5%. They use that money to keep their balance sheets liquid. They avoid fire-selling assets. They buy time. And who pays for this? Every single American who holds U.S. dollars. Because that Fed lending is not free. It expands the monetary base. It is inflation by another name. We are witnessing a stealth bailout of the commercial real estate sector. Not through explicit congressional appropriations. Not through TARP-style public programs. But through the back door, through discount window lending, through regulatory forbearance that allows banks to avoid marking loans to market, through appraisal guidelines that permit banks to ignore recent comparable sales if they can argue those sales were distressed. The game is rigged. The losses are being socialized. The Fed is using your money, your purchasing power, to prop up insolvent banks holding worthless office buildings. And they're hoping you do not notice until they can figure out a way to make this problem disappear. But the problem is not going to disappear because mathematics does not care about hope. Mathematics does not care about regulatory forbearance. And mathematics says, when you have $1 trillion in office building debt secured by collateral that is worth $600 billion, somebody is going to lose $400 billion. The only question is, who? Now we need to talk about the root cause. We need to talk about why this is happening. Because office buildings are not declining in value due to some temporary economic downturn. They are declining because the fundamental use case for office buildings has been permanently destroyed. Let me take you back to 2019, before the pandemic, before Zoom, before anyone had heard the phrase hybrid work model. In 2019, the United States had approximately 5.6 billion square feet of office space. Vacancy rates averaged around 10% nationally. Office buildings in major cities commanded rents of $50 to $80 per square foot per year, and the asset class was considered stable, boring, and reliable. If you were a pension fund or an insurance company, you allocated capital to office real estate because it generated steady cash flows. 7% cap rates, long-term leases with credit-worthy tenants, low volatility. It was the epitome of a safe real estate investment. But that entire thesis rested on one unquestioned assumption. Workers need to be in offices 5 days per week to be productive. Companies need centralized spaces where employees gather. Proximity matters. Collaboration requires physical presence. For 50 years, that assumption held. Office buildings were built on that assumption. Loans were underwritten on that assumption. Careers were built on that assumption. And then, in March of 2020, that assumption died in approximately 72 hours. When COVID-19 lockdowns began, every single office worker in America was sent home. Overnight. No planning. No preparation. Companies that had resisted remote work for decades suddenly had no choice. Everyone worked from home because there was no alternative. And you know what happened? Nothing collapsed. Companies kept operating. Productivity did not crater. In many cases, productivity increased. Workers discovered they could attend meetings in their pajamas. They could skip 90-minute commutes. They could have lunch with their children. Executives discovered they could save millions of dollars per year in rent. They could hire talent from anywhere. They could downsize their physical footprint and redirect that capital to technology or hiring or shareholder dividends. For 2 years, from March 2020 to March 2022, the grand experiment ran, and the results were undeniable. Most office work does not require an office. Now, starting in late 2022, many companies tried to force workers back. Return-to-office mandates were issued. CEOs demanded that employees show up 5 days per week, just like the old days. And you know what happened? Workers quit. Talent left for competitors offering remote or hybrid options. The companies with the most aggressive return-to-office policies saw the highest attrition rates. By mid-2023, the battle was over. Hybrid work had won. According to multiple surveys, as of 2025, approximately 60% of office workers in the United States are on hybrid schedules, working from home 2 to 3 days per week. Another 15% are fully remote. Only 25% are back in the office 5 days per week. Now, let me show you how this behavioral shift translates into an asset class apocalypse. This is where the mathematics becomes inescapable. This is where hope dies and reality takes over. Imagine a company that employed 1,000 people pre-pandemic. They leased 100,000 square feet of office space, 100 square feet per employee. Standard industry allocation. At $40 per square foot per year, they were paying $4 million United States dollars in annual rent. Now, 60% of their workforce is hybrid, coming in 2 to 3 days per week. 15% are fully remote. Only 250 employees are in the office 5 days per week. How much office space do they need? If 60% of workers are only in the office 40% of the time, that is 240 employees in office on any given day. Add the 250 full-timers. That is 490 employees maximum in the office at any one time. They need 49,000 square feet, now 100,000. They can cut their footprint in half. Their rent drops from $4 million to $1.96 million. They save over $2 million per year. Now multiply that calculation across every single corporation in America. Every law firm, every accounting firm, every consulting firm, every tech company, every financial services firm. They are all doing the same mathematics. They are all reaching the same conclusion. We can cut our office space by 40 to 60% and nobody will notice. Now, put yourself in the position of an office building landlord. You own a 30-story tower in downtown Denver. You have 20 tenants. 5 of them are up for lease renewal this year. Tenant 1 is a law firm. They have been leasing 60,000 square feet. They tell you, we are going hybrid. We only need 30,000 now. We will renew, but at half the space. Tenant 2 is a tech company. They say, we are going fully remote. We are not renewing. Goodbye. Tenant 3 is a financial services firm. They say, we will renew, but only if you cut the rent by 30%. Otherwise, we move to a cheaper building in the suburbs. Tenant 4 is an accounting firm. They say, we are consolidating into a smaller space. We will take 20,000 square feet instead of 40,000. Tenant 5 is a consulting firm. They say, we have 18 months left on our lease. We will fulfill it, but we are not renewing. We are going virtual. In one lease cycle, your building went from 90% occupied to 60% occupied. Your net operating income just collapsed by 33%. Your debt service remained the same. You are now underwater. Your loan maturity is in 18 months, and there is no way you can refinance at current income levels. This is not a hypothetical scenario. This is happening right now in every major city in America. Lease renewal rates for office buildings are at historic lows. Tenants are downsizing or leaving entirely, and landlords are powerless to stop it because the alternative space is everywhere. Supply exceeds demand by record margins. Vacancy rates of 20% nationally mean that for every 5 buildings, 1 is sitting completely empty. When supply vastly exceeds demand, prices collapse. There is no floor. There is no intrinsic value. An office building that nobody wants to rent is worth nothing. Less than nothing, actually, because you still owe property taxes and maintenance. This is why office real estate is not going through a correction. It is going through a reclassification. From productive asset to stranded asset. From income generator to liability. From valuable to worthless. And the transition is happening at a speed that is catching everyone, lenders, borrowers, investors, completely off guard. The impact of remote work is not uniform across all geographies. It is concentrated like a nuclear blast in the central business districts of major American cities. Let me show you what is happening in the urban cores, because this is where the devastation is most visible and most catastrophic. San Francisco is the canary in the coal mine. It is the future that every other city fears. According to the latest data from Commercial Edge, the vacancy rate in downtown San Francisco has reached 29%. 29%. Nearly 1 in 3 offices is dark. But the vacancy rate does not tell the full story. Let me give you the brutal truth about what 29% vacancy means for a city. First, tax revenue collapses. Office buildings pay enormous property taxes. When values decline 50%, tax revenue declines 50%. The city budget implodes. Services get cut. Infrastructure decays. The death spiral begins. Second, the ecosystem dies. Every office building supports an ecosystem of services. Coffee shops, lunch restaurants, dry cleaners, gyms, shoe shiners. When the office is empty, all of those businesses lose 70% of their customers. They close. The street level dies. The city becomes a ghost town during business hours. Third, public safety deteriorates. Empty buildings attract vandalism. Crime increases in areas with low foot traffic. The perception of danger drives even more workers away. Companies accelerate their exit plans. The spiral accelerates. San Francisco is living through all three phases simultaneously right now, and the numbers are staggering. According to recent reports, office values in San Francisco have declined nearly 50% since 2021. A building that sold for $100 million in 2021 is being offered for sale at $52 million today, and there are no buyers. Why no buyers? Because even at $52 million, the building does not cash flow. At 29% vacancy, there is insufficient rental income to cover operating expenses and debt service. The building is economically obsolete. It is a sunk cost. The only rational move is to walk away. And that is exactly what is happening. We are seeing borrowers mail the keys back to lenders. Strategic defaults. Not because the borrowers are broke, but because they have done the mathematics and realized there is no scenario in which this building ever becomes profitable again. The liquidation value is less than the transaction costs of trying to salvage it. Now, the mainstream media and urban planners have been promoting a solution. Convert empty office buildings into residential apartments. Turn offices into housing. Solve two problems at once: office vacancy and housing shortage. It sounds beautiful in theory, but the mathematics of office-to-residential conversion are absolutely brutal in practice. Let me walk you through why. Office buildings are designed for offices. They have deep floor plates, often 60 to 80 feet from window to core. They have minimal plumbing. They have HVAC systems designed for intermittent daytime use. They have electrical systems designed for computers, not kitchens. To convert an office building to residential, you need to add extensive plumbing for bathrooms and kitchens in every unit. Reconfigure the HVAC for 24/7 operation. Upgrade the electrical systems. Reconfigure the floor plates so that no unit is more than 30 feet from a window, because nobody wants to live in a windowless box. Bring the building up to residential code, which is far more stringent than commercial code. According to industry estimates, office-to-residential conversion costs between $200 and $400 per square foot, depending on the building. For a 200,000 square foot building, you're looking at $40 to $80 million in conversion costs. Now, add up the total investment. You buy the distressed office building for, say, $50 million. You spend $60 million on conversion. Total investment, $110 million. You have created 200,000 square feet of apartments. At current market rents, those apartments might generate $12 million per year in revenue. Subtract operating expenses of $3 million. Net operating income, $9 million per year. At a 6% cap rate, the building is worth $150 million. Congratulations! You spent $110 million and created $150 million in value. You made $40 million. Sound great, right? Wrong. Because that calculation assumes you can get permits quickly. It assumes no construction delays. It assumes no cost overruns. It assumes the residential market remains strong. It assumes you can lease up the building quickly at projected rents. In reality, the permit process takes 2 to 3 years in most cities. Construction takes another 18 months. Cost overruns average 20%. And by the time the building is ready, residential market conditions might have changed. You might have just spent 5 years and $130 million to create a building worth $120 million. You lost money. This is why, despite all the talk about conversion, very few conversions are actually happening. According to recent data, approximately 10 million square feet of office space nationally is currently in some phase of conversion. That sounds like a lot until you realize the United States has 5.6 billion square feet of office space. 10 million is 0.17%, is a rounding error. Conversion is not going to save the office market. It is a boutique solution for a handful of buildings that happen to have the right characteristics. For the vast majority of office buildings, especially suburban office parks and Class B towers in secondary markets, conversion is economically impossible. Those buildings are simply obsolete. If San Francisco is ground zero, New York is the fortress that was supposed to hold. Manhattan was supposed to be different. Manhattan has the finance industry, Wall Street. The concentration of global capital. Surely New York office buildings would hold their value, right? Wrong. According to Commercial Edge, Manhattan office vacancy is approaching 19%. Not as bad as San Francisco, but still the highest in decades. More importantly, Manhattan office rents have started to decline. Landlords are offering concessions. Free rent for the first year. Tenant improvement allowances of $100 per square foot. Anything to get deals done. But here's the really scary part about Manhattan: the debt. Manhattan office buildings are some of the most highly leveraged properties in the world. Loan-to-value ratios at origination often exceeded 75%. Property values were bid to the moon by global investors seeking trophy assets. Now those values are declining. According to recent reports, Manhattan office sale prices average $4,725 per square meter. That is approximately $439 per square foot. Sounds expensive until you realize. In 2019, Manhattan Class A office buildings were trading at $600 to $700 per square foot. The decline is real, even in the most prestigious market. When a 50-story Manhattan tower that is 40% vacant comes up for loan maturity, the refinancing conversation is going to be apocalyptic. The lender is going to order a new appraisal. That appraisal is going to come in 30 to 40% below the loan balance. The borrower is going to be asked to bring tens of millions of dollars in cash to closing. They will not have it. The building will default. And when trophy Manhattan buildings start defaulting, the repricing of the entire asset class will accelerate violently. We have covered the three-tier pricing structure. We have examined the debt maturity wall. We have analyzed the remote work revolution. We have toured the urban devastation. Now, let me tell you exactly what is going to happen over the next 36 hours and why Monday, January 6th, 2026, represents a point of no return. Right now, as I record this on Friday evening, thousands of commercial real estate borrowers across America are staring at spreadsheets. They are looking at loan maturity dates. They are looking at bank account balances. They are looking at appraisal reports. And they are making the hardest decision of their professional lives. Do I write a check I cannot afford? Or do I default on Monday morning? Let me walk you through the specific scenarios playing out this weekend. Scenario 1. You are a borrower with a $15 million loan maturing Monday. Your building has lost 40% of its value. The bank is demanding a $6 million paydown to refinance. You have $3 million in liquidity. You could write the check, but it would wipe out your reserves and leave you with nothing for operating capital. Do you bet everything on one last roll of the dice? Or do you walk away? Scenario 2. You're a regional bank credit officer. You have 37 office loans maturing in Q1. You have fresh appraisals showing an average 35% decline in collateral value. Your loan loss reserves are inadequate. If you foreclose and sell, you crystallize losses that will wipe out half your quarterly earnings. If you extend, you violate lending guidelines and risk regulatory sanctions. Do you extend and pray? Or do you foreclose and accept the losses? Scenario 3. You are a depositor at a regional bank. You read an article about commercial real estate stress. You Google your bank. You see they have 47% CRE concentration. You have $2 million in deposits, well above the $250,000 FDIC insurance limit. Do you sleep soundly over the weekend? Or do you log in Monday morning and wire your funds to JP Chase? These scenarios are not hypothetical. These are the exact decisions being made this weekend by real people with real consequences. When markets open Monday morning, several things are going to happen simultaneously. Let me walk through the sequence of events I expect to unfold. 8:30 ante-meridium Eastern Time. Regional bank stocks open for trading. Analysts at major brokerages have spent the weekend reviewing CRE exposure. Downgrade reports hit the wire. 3 regional banks are cut from hold to sell. The stocks gap down 3 to 5% at the open. 900 hours. The first default notices of the new year are filed. Court records show 17 commercial real estate foreclosure actions filed in Texas, Florida, and Arizona. Real estate news sites pick up the story. Wave of office foreclosures begins. 1,000 hours, a credit rating agency, let us say Moody's, announces they are reviewing the ratings of 47 commercial mortgage-backed securities with high office concentration. This is technical jargon for, we think these bonds are going to default, and we are warning investors. 1,100 hours, a small regional bank in the Southeast, assets under $20 billion, announces an unscheduled investor call. The CEO comes on the line. The bank is increasing loan loss reserves by $200 million in Q4. The stock drops 15% in minutes. Trading is halted. 1,300 hours, Bloomberg runs a breaking news alert. Regional bank office loan stress intensifies. The article cites the morning's foreclosure filings, the bank reserve increase, and quotes an anonymous analyst saying, "This is just the beginning." 1,500 hours, deposit outflows begin. Not at catastrophic levels, not bank-run levels, but meaningful. $1 billion flows out of regional banks with high CRE exposure and into money market funds. Then $2 billion. By market close, $5 billion has moved. 1,700 hours, the Federal Reserve issues a statement. We are monitoring developments in commercial real estate markets. The banking system remains well-capitalized and resilient. The discount window remains available to meet any liquidity needs. That last statement, the Fed reassurance, is what tells you the situation is serious. The Fed does not issue reassuring statements unless there is something to be worried about. What I just described is day one. Monday, January 6th. Now, imagine that cycle repeating every day for weeks. More foreclosures, more reserve builds, more deposit outflows, more Fed reassurances that only increase anxiety. This is how financial contagion spreads, not through one catastrophic event, but through a grinding, relentless feedback loop where each development makes the next one more likely. Foreclosures lead to comparable sales. Comparable sales lead to appraisal reductions. Appraisal reductions lead to reserve builds. Reserve builds lead to earnings warnings. Earnings warnings lead to stock declines. Stock declines lead to depositor anxiety. Depositor anxiety leads to outflows. Outflows lead to liquidity stress. Liquidity stress leads to forced asset sales. Forced sales lead to more foreclosures. The loop closes. The spiral accelerates. And here is the truly terrifying part. Nobody knows where the bottom is, because this is not a normal real estate cycle. Normal cycles are driven by temporary demand shocks or overbuilding. Demand eventually recovers. Prices stabilize. The cycle turns. But this cycle is driven by a permanent structural change in how we work. Demand for office space is not coming back. Remote work is not a fad. Hybrid is not temporary. The asset class is in secular decline. And when an asset class enters secular decline, there is no bottom. There's only the slow grind toward zero. Now, let me tell you who wins and who loses in this historic repricing. Because this is not just an academic exercise in market dynamics. This is a wealth transfer of staggering proportions. Trillions of dollars are about to change hands. And understanding who ends up with the money is critical. Let us start with the obvious losers. Commercial real estate borrowers who bought office buildings between 2015 and 2021. These are property owners who purchased at the peak, who underwrote deals assuming perpetual 5% rent growth, who levered up to maximize returns. They're going to lose everything, not just their equity that is already gone, but their personal guarantees, their reputations, their careers. Next, regional bank shareholders. When banks start recognizing the full magnitude of CRE losses, earnings will collapse. Dividends will be suspended. Stock prices will crater. Shareholders who thought they owned boring, stable bank stocks are going to watch those stocks decline 40, 50, 60%. Some banks will be acquired at fire sale prices. Others will fail outright. Next, employees of regional banks. When profits collapse, banks cut costs. They close branches. They lay off staff. The regional banking sector employed over 600,000 people pre-pandemic. That number is about to shrink dramatically. Next, commercial mortgage-backed securities investors. Trillions of dollars in CMBS are backed by office buildings. As those buildings default, CMBS holders will suffer losses. Pension funds, insurance companies, mutual funds, retail investors who own bond funds with CMBS exposure. They're all going to take hits. Next, taxpayers. Because when regional banks fail, the FDIC steps in. The FDIC insurance fund covers deposits. But if losses exceed the fund, the shortfall gets made up through special assessments on surviving banks, which get passed through to customers, or through Treasury support, which means taxpayers. Either way, the public is on the hook for cleaning up the mess. And finally, cities. Urban tax bases are collapsing. When office buildings lose 50% of their value, property tax revenue drops 50%. Cities cannot cut expenses that fast. Budget crises, service cuts, infrastructure decay. The downward spiral of urban decline that we saw in the 1970s and 80s is back. So who wins in this apocalypse? Who walks away with the wealth that is being destroyed? First, the lawyers. Foreclosures, bankruptcies, loan workouts, restructurings. Every distressed office building generates hundreds of thousands of dollars in legal fees. The bankruptcy bar is about to have the best decade in their history. Second, distressed debt investors. Private equity firms that specialize in buying bad loans at deep discounts. They will buy office loans from banks at 40 cents on the dollar. Foreclose. Acquire the properties. Hold them for years. Wait for a use case to emerge. Then sell at 60 or 70 cents and make 50% returns. This is what Blackstone and Apollo and Oaktree do. They're salivating right now. Third, well-capitalized buyers of non-office real estate. Because when regional banks pull back from all commercial real estate lending, not just offices, but retail and industrial and multifamily too, there will be a financing gap. Buyers with cash will have massive negotiating leverage. They will acquire assets at steep discounts from desperate sellers who cannot get financing. This is how fortunes are built in dislocations. Fourth, remote work technology companies. Zoom, Microsoft Teams, Slack, Asana, all the collaboration software that makes remote work possible. They're the direct beneficiaries of the trend that is destroying office real estate. Their revenues will grow as office landlord revenues collapse. It is a perfect zero-sum transfer. Fifth, residential landlords in suburban and exurban markets. Because if people do not need to commute to urban offices 5 days per week, they can live farther out. Demand shifts from expensive urban apartments to cheaper suburban houses. This trend is already well underway. Residential rents in suburban markets are rising while urban rents stagnate. The wealth transfer from urban to suburban is accelerating. And finally, the biggest winner, the Federal Reserve and the federal government. Because when this crisis reaches its peak, and it will, the Fed will step in with emergency measures. They will buy distressed CMBS to stabilize markets. They will expand lending facilities to regional banks. They will, in effect, monetize the losses. And monetization means inflation, which means the debt gets repaid in devalued dollars. The government wins. Savers lose. So when does this end? When do we hit bottom? Let me give you my timeline based on historical precedents and current data. 2026, the year of recognition. Foreclosures surge. Banks increase reserves dramatically. Stock prices of regional banks and REITs crater. CMBS spreads blow out. But prices do not bottom yet because sellers still have hope. They think this is temporary. Demand will come back. I just